Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. The fall in the benchmark indices is not bad given the context where Asian markets are and where US markets closed yesterday. But banks are the problem pocket. The Nifty bank, though it's recovered a bit from the lows, is still down close to about 600 points, and banks continue to underperform. Week to date, the Nifty banking index is down 3%, while the benchmark indices are down 1%. And you pull up the contribution plate, while Axis Bank doesn't have a big weightage on the Nifty, it's just about 3-4%. But Axis Bank is, the stock which has seen the biggest fall today. It's dragged down names like ICICI Bank with itself. So that's the reason why the frontline, you've seen that pressure coming through, a 100-point cut coming through on the Nifty, and it's courtesy largely Axis Bank and an ICICI Bank. In the Nifty bank, Axis Bank is a near 10% weightage, and Axis Bank is taking away more than 50% of the Nifty bank fall today. And not to forget the Asian market context, where Nikkei is bleeding, that's down close to about 3%. Kospi, Hang Seng, all down 1.5%.
Absolutely. I mean, we woke up to a big slam dunk on global screens, right? And it's still playing out. It started with, of course, the whole tech sell-off, some weak earnings. In case you missed it, Alphabet's numbers not going down too well, Tesla missing the mark. So it just led to this panic reaction on Wall Street. It continued the whole day there. It's continuing across Asian markets this morning. So in that context, this is not a bad performance at all. The fact that dips are getting bought, but hey, then that is this market. That's what we have been, the buy on dips market, right? So there you go. You've got the Asian indices for reference there as well, still nursing deep losses. Now on the Nifty, Reema's already spoken about banks and Axis. We'll spend some time understanding what's gone so wrong. Look at the rest of the Nifty chart. The good news is that stocks like L&T, for instance, they're helping this recovery. So let's see if the bulls can actually build on it. Because if I look at the Nifty contribution and the top side of the screen, then some of the banks like Kotak are contributing, HDFC Bank obviously is contributing, and L&T is the one that's fighting tall. Not to forget some of the tech names as well. I mean, TCS, for instance, trying real hard. It is in the green side for the time being. So let's see if some buyers can come back to tech. Wipro, TCS, these are some of the names that are helping matters. On Tata Motors, of course, a couple of very positive brokerage comments have come in, which makes Tata Motors the winning stock on the Nifty. Look at that. I mean, two extreme reactions. There's Tata Motors up 5%, and there is Axis, which is down almost 6%. So pretty extreme moves on the Nifty today. Speaking of Axis Bank, let's start there because there's no recovery in this stock whatsoever. The numbers were weak and largely I think the street's concerned deals with asset quality and credit costs. Let's go across to Abhishek and get more details. Abhishek, what has gone so wrong and what is the word out there?
The raw material. Now that's a struggling factor for Axis Bank because deposit growth is at 12.8% YOY. This is the weakest growth that you are seeing in last 6 quarters, and sequentially deposits are down 0.6% quarter on quarter, and that's perhaps the highest decline that you are seeing in last 4 quarters. So that has also led to weakness in loan growth. So loan growth is at 14.2% YOY and about 1.6% on a sequential basis YOY, and quarter on quarter this is the weakest growth in last 8 quarters. Now operating profit has declined 4.1% quarter on quarter, the weakest growth rate that you are seeing in last 8 quarters. Core operating profit growth is just 1.3% sequentially, which is the weakest rate that you are seeing in last 4 quarters. Talking about asset quality, the woes are higher than street estimate. So the slippages have come in at 4,793 crore. Analysts were working with a number of 4,000 to 4,500 crore. This is largely led by the unsecured or the retail segment as well. Annualized slippage ratio is at 6-quarter high of 1.96%. That's driven the credit cost to be the highest in last 12 quarters at about 1.04%. Analysts were penciling a credit cost of 0.45 to 0.5%. And the guidance from the management is that going ahead, credit costs will rise, and the best is behind with respect to FY24 credit cost. Gross NPA ratio has increased quarter on quarter for the first time in last 12 quarters, and that's a disheartening factor as well. Watch list has increased by almost 11% on a sequential basis. This has impacted the return ratios. Both the ROA and ROE are one of the weakest that you are seeing in last 5 quarters. ROA at 1.65% and ROE of 16.3%. Now CASA ratio is also one of the weakest in last 16 quarters, coming in at 41.8% versus 43% in the previous quarter. But this is an industry phenomenon wherein you are seeing CASA ratio decline for majority of the banks. PNL, both the ANA and PAT is on a beat on our poll, but they have a one-off income with respect to interest on income tax reversal of about 100 crores in this PNL. Back to you.
Thank you very much for that, Abhishek. UBS points out that deposit gathering was anyway a challenge for most of the private banks.
Correct.
We've been highlighting. But now the spike in credit costs is an added headache, which has come through. So now all eyes will be on ICICI Bank when it reports numbers at the end of this week. The stock, ICICI Bank, remember, is up 20% so far year to date. Anirudh Garg, partner and fund manager at Inva Asset PMS, is now with us on the show. Anirudh, morning. Thank you very much for joining in. What's the call on banks, particularly these large cap private sector banks? And while the valuations are reasonable, relative valuations are reasonable, are we being too optimistic about the kind of earnings growth recovery in banks which justify, increased valuations from here?
Thank you for having me. A very good afternoon to everybody at the CNBC-TV18 team. So, for how we look at it's a very, tricky sector to operate in. If you have lent for the past 10 years, books in the past 10 years, somewhere due to quarter-on-quarter and year-on-year expectations, some bad, that is something that has happened and highlighted by Reserve Bank of India from time to time. This is one problem that I believe is plaguing the public sector large banks in India. The second problem is the money which is flowing into alternative assets and the stock market, which is being taken away from the FDs. We've seen the CASA problem from time to time. And, I think that is absorbed now that the CASA depreciation is happening within the banks. I believe below there will be rise in, the interest costs and the net interest margins come down even further from here as, the money is flowing from the banking industry, from the FD side to the stock market or the mutual fund and SIP side. So yes, the banks, we are not bullish on the private sector banks. When it comes to financial, we believe that the main themes that are out there, the capex which the government is aiding, anybody, all those companies which are providing finance to these particular themes should do pretty well.
Anirudh, just allow us 20 seconds. We'll just fix that line, I think, because of this incessant rain in Mumbai. I think we're having a bit of a patchy issue over there. In the meantime, I'm just looking at some of the commentary that surrounds the Axis Bank numbers as well. So a lot of brokers are still retaining their buy. I mean, this stock has been a favorite with a lot of foreign institutions and foreign brokers in particular. JPM still has an overweight. They've in fact raised their target to about 13.25 from 12.25. There's a 100 rupee increase on the target. They're saying that while gross slippages rate was broadly similar to the first quarter of last year, net slippage rate was higher due to slower recoveries, which the management expects to pick up. Citi has actually downgraded the stock. So Citi is a bit of a bear on Axis, downgraded to a neutral with a target price of 13.20. And again, they're talking about the asset quality issue. And they're saying that, they need to factor in higher credit costs and therefore they're revising the earnings lower. So the debate is wide open on Axis Bank. I think we've got Anirudh back. Anirudh, sorry, if you could just continue that point you were making on financials. I think that's the biggest issue in this earnings season. Large banks showing either a flattening trend on margins, anyway chasing deposits is an uphill task. And then you have some of them now looking at credit quality issues or asset quality issues.
Yeah. This is something that because of the books the banks have made in the past 10 years, in the last 1 decade, we were seeing a clear distinction. The public sector banks were not making books. They were clearing their bad books and especially on the order, then coming to corporate banks like ICICI and Axis were doing. Now we are seeing global growth is a problem due to which the are not doing pretty well. We are seeing metal prices not picking up. So primarily the corporate lending that they do to industrials and such is not doing great. Your raw material is not there. You're not able to increase your CASA. Your credit costs are going up. And on the other hand, retail lending, which, was always a cherry on the cake, which, compensated for all the bad deeds that you have done in lending, is also seeing some bit of problem due to excess competition and excess liquidity. And I believe somewhere where RBI there is problem in the retail lending, banks are not our favorite going forward for the next couple of years.
Okay. Anirudh, unfortunately, we'll keep the conversation short today because of these technical issues with the line, but we got the gist of it. Look forward to talking about other sectors as well on our next call. Thank you so much for joining in. I think in the next couple of seconds, Nestle's numbers should be hitting the screens as well. The stock, of course, has been holding up quite okay. The expectations, okay, we've got it 746 versus 815. That doesn't look too great. The margin expectation is 23.7, which is going to be an improvement. That's the Manglam's poll. Revenue 4814 is also lower. This is a top-down miss. Looks like a top-down miss from Nestle. Let's see what happens. The expectation is that the volume growth should be about 4 to 6%. So let's see if it is the volume growth that has disappointed. But right now, revenue is lower and the profit is lower as well. The EBITDA number that we are looking at is around 1,200 crores. That's what the poll has thrown up. The margin expectation, as I said, was about 100 basis points improvement. Let's see if that's come through or not. This is not looking good. This is a top-down miss. Even the EBITDA has missed. So let's see what comes out of it. I'm just going over Manglam's poll again. So 4 to 6% is the volume growth expectation, with the domestic revenue growth seen in double digits. Now, once we get the breakup, we'll see. But obviously, that's margin 22.9. So yeah, it's an all-round miss. Actually, I mean, having said that, I think the stock's not falling too much because of market positioning as well, right? We know that consumer is a space where a lot of fund managers are rotating into. They're coming out of banks. They're coming out of the capex themes and allocating some more money to consumers. So the overall market setup perhaps is helping Nestle. Otherwise, these numbers are not looking too good.
We got a hint when the global sales came out. And I was just reading that Nestle had cut when the Swiss, it's a Swiss company, and when they came out with the global numbers, they're saying that we're now targeting a 3% revenue growth versus 4% earlier. This is at the global level because prices have come off much faster than what they had earlier anticipated. The stock, as you can see, is still down 1%. Not a big fall, but under pressure given, but even the market is down close to about 0.5%. I think we have Prakash Diwan joining in. Prakash, looks like a top-down miss on the revenues, miss on the margins. 1.3% gone on the stock now.
Yeah, so, we were anticipating some weakness and in the absence of any kind of a trigger in this quarter, this is not a surprise in that sense. The direction is correct. It's just a quantum that's probably slightly more. The EBITDA is about 100 crores off. My sense is, Nestle is itself undergoing a little bit of a consolidation internally in terms of the product mix, the new, the Gujarat unit that they've set up. Once that starts kind of rolling out some of the products in logistics, this thing will change dramatically. So I think it's par for the course. There's nothing very upsetting about these numbers. But given the fact that FMCG will see a lot of consumption-driven, push, which we've seen in the budget as well, especially in the tier 2, tier 3 locations, they could benefit out of that swing. So hope for that. Gives you a good entry point of sorts, actually, if you ask me.
Exactly. It's all about market positioning, Prakash. I mean, had these numbers come at a point when FMCG was rallying 100%, I mean, stocks were up, maybe things would have been very different. The stock, let's pull up a one-year chart on Nestle. It's done absolutely nothing. It's been, complete underperformer compared to the rest of the market. Maybe that can cushion the fall, given the overall mood and the shift in portfolio allocations. So there you go, 12 months, about a 10% up move. I think we've got Manglam in. Let's understand the here and now and what's behind this. Manglam looks like a top-down miss.
It is a top-down miss for Nestle. In fact, it's a weak set of numbers, more so if you look at it in terms of the performance that is coming from other FMCG companies. So a couple of things that really stand out in Nestle's numbers this time around. Domestic sales growth has just been 4.2%. This as against Nestle's own run rate of near double-digit growth for the last 10 to 15 quarters for the domestic business in particular. So maybe at some point, high base is catching up. The company itself is, acknowledging weakness in consumer sentiment. They've called this quarter having a lot of external challenges such as lower consumption growth, concerns on continued food inflation and volatile commodity prices. They said that they've delivered growth across all their products. 5 out of their 12 brands have grown double-digit, but typically Nestle would have more than 8 or 9 brands out of their 12 growing in double-digit. So that's been a bit of a problem. Pace of growth has slowed down. Margins too, as a result of which, have come in slightly lower than street expectations at 22.9% versus a poll of 23.7%, and as a result of which the net profit has grown 7%. Now, the thing for Nestle going forward is that their expansion into non-urban towns would be something that we'll be eyeing very closely, because if the street has to play the rural recovery theme, then Nestle does not participate in that, largely because 75% of their revenues comes in from urban India. So their expansion into rural is something we'll be watching out for. And the fact that they were, immune to the slowdown in rural over the last couple of years gave them an edge over the other FMCG companies on the street, and as a result of which they were also trading at 71 times FY25 earnings. So valuations not supportive. Even though the royalty hike issue is out of the system, going forward, demand for urban India and continuing that pace of growth at a time when others would grow faster because of rural recovery is something that Nestle will have to contend with, and as a result of which the stock currently at the lower end of today's trading range.
Thank you very much for that. In fact, this whole month, it's the rural-facing FMCG companies which have done well. Marico is up 9% in July. HUL is up 8.5%. Dabur is up 4.5%, as opposed to Nestle, which is down 2%. So in the FMCG, the positioning, the pivot is towards the companies which benefit from a rural recovery. Rains have been good, very, very strong, in fact. Even the Kharif sowing has been fairly robust. So the street is backing more on the rural-facing. For Nestle, it's a missed Q1. But as Mangalam pointed out, we will watch for their expansion into Tier 2, Tier 3 cities. We will slip into a break on that note. We'll come back and talk commodities. Manisha Gupta is waiting by.
Welcome back. Time to talk commodities. We have Manisha Gupta joining in. Manisha, what are you looking at? The rains today or something else?
Well, I'm looking at precious metal prices because, yes, India has had that very sharp correction in prices, and that is because the duty has been slashed from 15% to 6% now. You also are now looking at the international prices also coming down. So when you look at the international markets, the gold has come off its all-time high of 2470 to almost 2370 and counting on the lower side right now. So this has been a big correction. The strength in US dollar index really seemed to be weighing, and also the fact that the regional equity markets are selling off. The base metal prices have been declining. Silver shot down by nearly 3% overnight, and that seems to be weighing on gold as well. So it has been a very sharp correction on the lower side here. If you look at the gold prices right now, we're trading at a 4-week lows. Gold in the international markets was trading at a 2-week lows as well. Silver is now trading at 2.5-month lows as well. So if you look at the chart now, on a week-on-week basis, we have seen the gold prices decline by 3% on week, and that has made the month also in the negative there. The silver prices have declined by 6% on week, and this is also down by 3% for the month of July until now. Going forward, it is going to be the second quarter US GDP numbers that is going to be released today, and you also have the PCE numbers coming in from US markets tomorrow. Also, when you look at the Indian markets itself, we did see an all-time high in this month itself at 74,500. We've seen the prices come down all the way to 67,600 right now, with many market experts now pointing out to 66, even 65,000 on the lower side for the gold prices.
Thank you very much for that. Get into a break. On the other side, we'll invite the management of IndiGrid to talk about their Q1 numbers. Welcome back. Let's talk about Aurionpro. The company reported their numbers yesterday. It's a good set of numbers. The company's revenue growth stands at 6% on a quarter-on-quarter basis. On a year-on-year basis, revenue growth stands at 32%. Margins too have been maintained at 21.2%. To talk about the way forward, we have with us Ashish Rai, CEO at Aurionpro Solutions. Ashish, thank you very much for joining in. Good start to the year. Are you maintaining your full-year guidance? And just for our viewers, it was at 30 to 35% top-line growth, EBITDA between 20-22%, and PAT margins at 15 to 16%. Are you maintaining the full-year guidance?
Yes, yeah. So thank you. First of all, good morning and thanks for having us. Yes, so Q1, I think pretty good start. We feel good about the full year guidance of 30 to 35. The order book is in a good place. Pipeline is in a good place. Team is executing very, very well against the opportunities we see. Yeah, so we will stick to the guidance.
Okay. Is there a possibility that you might exceed the 35% revenue growth? Given the visibility, or are you going to be at the lower end? And is your business geared up for this 30 to 35% over the longer term? Is this something we can expect for 4-5 years?
Yeah, so look, I think we've been growing at 30 to 35% pretty much for the last 4 years since we pivoted into our current journey of building out a global products and platforms player, right, which is focused on a few segments, banking, payments, transit, etc. We see the demand runway as a pretty long runway going out the next 6, 8, 10 years in each of those spaces, because there's something fundamentally transformative happening in the space. So, right, we feel very good about the demand runway. The opportunity size is really large for each of these segments. The reason we stick to 30 to 35% for the last 4 years, and we hope to do for the next 4 as we go into 2030, is essentially to calibrate the delivery capacity to capitalize on the demand, right? So I think will we have a little bit of an upside? It's possible that you can't really fine tune to the last percentage point, but the last 4 years, so last year as well, we grew 35%, right? So I think we feel good about staying in that band. We're not going to change our guidance at the moment. I think if we go into Q3 and it's looking like it will change, we'll guide at that point. But we feel very good about the demand runway for each of the major lines that we have.
Got it. So you're sticking to that revenue target of 30 to 35% growth. Mr. Rai, I believe you've also got final approvals to set up a payment aggregator business, right? From the Reserve Bank of India. So tell us a little more about it. And you would have done some math in terms of the revenue implication, the profitability of a business like this. What are you thinking? Just take us through, also the numerical implications and the strategy behind setting up a payment aggregator business.
Yeah, so thanks for the question, right? So yes, we did receive the final authorization for RBI in Q1. I think it's a great endorsement of both the technical capabilities that we built up over time, as well as the process framework and the operational capabilities overall. The goal is to really create a next generation of a specialized next generation payments player who's highly specialized. That's why we feel good about our ability to keep margins in the space as well. The goal is to ride on spaces where we are already strong in. So Aurionpro's approach typically is to really, when we are in a space, try and be an end-to-end player across the value chain. For example, transit payments, we are very prominent in. We are probably the most integrated end-to-end offering stack in the transit payment space, from hardware to software, AFC, etc. This was a gap in our portfolio. This now allows us to really have the full spectrum end-to-end play on the transit side.
It's going to be sir, just to understand, Mr. Rai, is this going to be sort of a B2C offering? And isn't that already a very crowded space? And what about sort of break-even targets? How much will you spend on setting up this business? And what are your profitability and margin expectations from it?
Yeah, so look, we're not that kicked about the B2C space. We think it is a fairly cluttered space, right? So what we are looking at is right on areas where Aurionpro is strong. So for example, in transit, for us, it is a margin expansion play because we already own the end-to-end contracts. In the B2B space, where we have, for example, ROBs like the SME SaaS offering, there is a space for us to expand our margins and revenue as well by adding payments functionality to it. So the goal for Aurionpro always is to play a combination of software together with a payments capability or something else, right? So we don't like vanilla plays, we like non-linear plays, and payments capability allows us to really bring that next generation of specialized offerings in the market. The plain vanilla B2C space, I think you're right. I think it's cluttered and it's hard to really get margins in that space.
All right, we'll leave it there, Mr. Rai, for now. It's a shorter call today, but we look forward to a longer discussion next time you're with us. Thank you for joining in. That's Aurionpro. By the way, look at that number, 1% volume growth, and that explains that underperformance or the fact that the results were basically below expectations for Nestle. That's a lot lower than what the poll had thrown up. 4 to 6% is what we were expecting. Street was expecting 1% is what Nestle has done, and the pressure is back now on the stock. I think with that, we can take another very quick break. We'll come back on the other side and get you a lot more. But before we take that break, there's a quick update coming in. As we slip into the break, a special announcement for all our viewers about an exceptional evening that is lined up ahead. We are honoring the heroes of India's economy, a prestigious ceremony where we are celebrating the SME champions who are building our nation brick by brick with a 5 trillion economy on the horizon. We must acknowledge the unsung heroes, our small and medium enterprises. India's one of the coveted SME awards platforms is here to recognize, honor and celebrate the builders of India's economy. HSBC presents CNBC-TV18 SME Champion Awards, all set to finally announce the winners tomorrow, 26th of July, 5:30 p.m. onwards. Welcome back. Now, in what could be a big setback for miners, the Supreme Court has rejected the plea by miners and the centre against levy of cess by states. It seems the Supreme Court is going to allow states to levy cess on mining. Ashmit is here with the details. Ashmit, this could have serious implications, right? Even in terms of future leases.
Indeed, just to run you through some of the companies that were actually contesting this before the court, the likes of SAIL, JP Associates, Hindalco, Hindustan Copper, Ultratech Cement, JK Lakshmi Cement, Ambuja Cement, Tata Steel. These are some of the companies that were before the apex court. The issue being contested was, can a cess on mineral output be levied by the state governments? Now, mind you, this issue, the clarity is coming from the Supreme Court after 9,000 days. It's a 25-year-old dispute. The centre, the miners, the state governments were before the apex court. The question was being contested. Finally, the apex court has given clarity, and in this clarity, setback for miners as well as for the centre, a huge win for mineral-bearing states. The Supreme Court holding that, yes, the state legislatures, the state governments do indeed have the legislative competence to levy a tax based on mineral output. That is a big clarity coming in. The Supreme Court clarifying that this is not a domain where the Parliament or the centre has exclusive domain. The states do have the power to levy a tax. What the Supreme Court also says is that the MMDR Act, which governs the levy of these royalties, etc., do not place any limitation on the state governments. So the state governments are at full liberty to go ahead and to levy that cess. That state legislatures have the legislative competence to tax the land. The Supreme Court also giving clarity that the mineral yield, the output that is coming from these mines, can in fact be used as a basis for a levy of cess, a levy of tax by the state government. So again, a big landmark judgment coming in from the apex court, coming from 9 judges. In terms of impact, 4 aspects to look at. Number one, this will, of course, translate into increased tax outgo for the cement companies, mining companies, the ones that we mentioned. On the second key impact is that it allows room for legislative room for the state governments. They can either increase, decrease this levy of cess. The other mineral-bearing states can also contemplate similar action. Number 3 impact is, of course, is the setback coming in for the centre. They had been arguing that the centre has the exclusive domain over levy of such taxes. And finally, a huge win as far as the state governments are concerned, mineral-bearing states, Jharkhand, Odisha, Karnataka, Chhattisgarh, all of these states with a vast number of mineral resources. They are now looking at thousands of crores in additional revenue over the life of a mining lease. Back to you.
Thank you very much for that. That's an important story. We'll keep coming back to it. For now, it's a break. On the other side, we'll invite Keshav Bhajanka, Executive Director of Century Plyboards. Welcome back. It's been our endeavor to find out the demand situation on the ground and how this budget changes things around. Keshav Bhajanka, Executive Director at Century Plyboards, is with us on the show now. Mr. Bhajanka, in the past you've said that the wood panel industry is facing rising raw material costs that cannot be passed on to the end user because of sluggish demand, which is resulting in moderate profitability for the entire sector in the near term. Is there anything in the budget which changes this assessment, and how is the demand on the ground for you?
Hi, good morning. I think it has been a reasonably good budget. A couple of the initiatives, for instance, continuation of 11 lakh plus crores for infrastructure, the emphasis on the Pradhan Mantri Awas Yojana scheme where 3 crore plus houses are going to be built. All of these bode very well for the medium and the long term. I think that the focus on employment in the short term is also going to help all manufacturing sectors, including ourselves. Having said that, yes, the situation on the ground still remains that demand is not as robust as it was a year earlier, and raw material prices have moved up. I think this correction will take at least another quarter or two to play out. But post that, I'm seeing that, yes, we will be back to a position where there is more of a demand-supply equilibrium, where the raw material prices will be passed on and margins should resume or return gradually towards normal.
The difference in your cost of production versus the end-use price, how much do you have to bear in terms of the difference between the two?
I think we'd be closer to 5% as far as MDF and particle board are concerned. In plywood, we have been relatively successful in passing on the majority of the raw material increase.
Yeah, Keshav, hi. Good to have you on the show. I think you took a price increase on the plywood segment in June, if I'm not mistaken. So on the other segments, any chance of price hikes? I mean, how is the demand-supply equation in the market?
Hi, good morning. Thank you for having me. I think that in plywood in June, and we're looking at a further price increase in plywood, perhaps within the current quarter itself. Having said that, going forward, in the other segments, there is going to be scope for price increase, but we'll have to play it by the ear and we'll have to see how it progresses. In the immediate short term, I don't see anything major happening, but there are possibilities for an increase sooner rather than later.
Your guidance, if I'm seeing the right numbers, was plywood about 10% revenue growth, laminate 20% growth, and MDF was 40% growth. Now, the budget does talk about a lot of impetus on housing, right? I mean, there's the allocation for the PMAY scheme, plus this interest subvention scheme for the lower and the middle segment as well. We'll need to see how that plays out. But generally, because a lot more houses are going to be built, does the budget give you any reason to up this guidance?
You see, for us, our products come into play more during the finishing stages, when it goes from a house to a home. So it doesn't really go so much in the construction phase. It goes when a person is shifting into their home. So as such, short term, this is not really too much of a shot in the arm. But going forward, say a year hence or a year and a half hence, this is definitely going to increase and accelerate our growth.
So getting back to plywood, where you've been relatively insulated and you've performed well in terms of being able to pass on the increase in raw materials, I think you've guided for a 10% revenue growth for this year. For the plywood segment, and that's over 50% of your revenues. Are you going to maintain that? Do you maintain that, or is there scope for an outperformance?
You're asking me very difficult questions, but as of now, I'd say no, we will definitely try to maintain that. The objective is to outperform the same, but as of now, yes, we're very confident that we'll maintain the same.
Okay. All right, Keshav, good talking to you as always. Thank you very much for joining in, giving us a sense on the business. So we'll watch out if the price hikes can happen in the other segments as well. And of course, see how the rest of the growth progresses. Thank you for joining in. That is Century Ply, take on the budget. We will take a quick break on that note. Come back on the other side and we'll get you some more updates on the market. All right, we are sticking with all the important commentary coming in after Budget 2024. The government has taken a balanced approach towards divestment. That is the word coming in from Revenue Secretary Sanjay Malhotra. Let's listen into excerpts from our conversation with the Revenue Secretary as well as the Finance Secretary on the government's roadmap for divestment going forward.
The challenge that the government seems to be faced on that front, disinvestment has continued to be a pain point where we haven't been able to achieve the kind of numbers that were set out. What is the outlook now? What is the realistic roadmap as far as disinvestment is concerned? I mean, how should we read the government's approach and strategy now when it comes to disinvestment?
No, I don't think, we should call it a pain point, for the government. The government has taken a very, very balanced and a practical approach towards disinvestment, because it's not, only disinvestment, the proceeds that come out of disinvestment that are important. We need to calibrate it, because if we are going to keep on, disinvesting year after year after year, we are going to erode value and we are not going to get, the correct value for our investments. So it's important that, we have a calibrated approach towards it, and you have seen this. And Secretary Deepam is actually, the right person you should be asking this question to. However,
He's not here, but we heard him yesterday.
Having heard him,
yes.
So many times, I can speak, on his behalf, that that a lot of, value creation has happened over the years, over the last couple of years, especially, once, we have calibrated this selling of government investments. And we, as well as, the public, will reap the benefits thereof in the years to come.
So where else do you believe there is a strategic consideration that the government must consider, and where do you believe that the government could look at a much more commercial consideration and take the step forward as far as disinvestment is concerned, or is that not an expectation?
There are many areas where a commercial consideration could lead to privatization or disinvestment, and I'm, as my colleague Mr. Pandey has repeatedly been saying, they are not off the table at all. But it's one thing to say, this year I'm going to sell company X, and then the whole market waits for us to dump X and starts acting in anticipation, versus saying that I'm an investor. I have a portfolio of securities that I own. Some I'll continue to be majority owner in. Some I'll continue to be minority owner in. Some I'll dilute my majority stake. Some I will do nothing and collect dividends. And some I'll hold until they are repaired. And we take a pragmatic and maybe even opportunistic view of what to do with each of these. That is the new approach. But you will see disinvestments happening. They'll happen not perhaps to a declared pre-announced calendar, but you will still see them happening, is our both expectation and policy.
Okay. Still see disinvestments happening. I know that Vineet Agarwal, you have a question related to disinvestment.
Perhaps you should not consider disinvestment of certain assets like Concor, which is a very, very strategic asset for the country. Even things like Shipping Corporation of India should be repurposed into container shipping lines. India desperately needs a container shipping line. We know countries like China and others have actually leveraged that very effectively, especially during times of COVID. And even now when we are focusing a lot on merchandise export, it's clearly if you do not have the right container shipping lines available at the right prices, we will lose out. Only 5% of India's trade actually goes out in Indian shipping lines. So, and that leads to other questions of not just divestment, but also related to shipbuilding and so on and so forth.
Thank you.
Well, point taken, Vineet. Many thanks for that.
All right. Well, with that, we'll take a quick break, come back with more on the markets in just a bit.
Welcome back. The mid-cap index is now back in the green. It's recovered a good 600 points from the day's low. So it continues to outperform the frontline indices. A lot of individual stocks are doing well. So pull up something like a Jyoti Laboratories. Came out with numbers a while back, an 8% revenue growth. There is an expansion seen in the company's margins by 80 basis points. That stock has seen a gain of close to about 6%. CG Power, again, good set of numbers. We chatted with the management earlier, and that stock is up. PSUs like STC, MMTC, ITDC continue to see a fair amount of buying. In fact, once again, let's pull up the PSC index. And yes, That's the big outperformer. The Nifty PSC index is up 1.7%. So the gains continue unabated there. With that, we're going to wrap up on Trading Hour. Stay tuned. The halftime report is up next.